Hello there. Welcome back to my channel. In this video, we want to look at a question from the question paper of November 2024. So we are going to look at a question on preparation of the income statement using the direct cost method. So basically, that's what we have according to our question. So our question that we have is a question 5 on the question paper. So we're going to go through the question before we answer the question. So the question reads, the following information was extracted from the records of Southwest Manufacturer. You are given general ledger of Southwest Manufacturer. That is, you are given material control. You are given labor control, manufacturing overhead control, selling and administrative control. So these are the accounts that we have on the first part. Then moving on, we've got further information in terms of additional information that you need to go through. Then on the required part, in brackets, round off your answer to the next whole number. So basically, we take note of that. Then 5.1, prepare the income statement according to the marginal or direct costing method. So basically, that's what we are going to do. Remember, preparation according to the direct cost method, we are going to say sales, and then we subtract total variable costs to get our marginal income. Then when we have got our marginal income, then we subtract total fixed costs to get your net profit. So basically, the final figure that we are calculating in that income statement is the net profit. So we just follow that format whereby we subtract variable cost first, and then later on we subtract the fixed costs to arrive at the net profit. So going to our answer section, see that this is going to be our answer section. So we are going to start with the figure for our sales. So for sales, we are going to refer back to our question to see what figure for sales do we have. If you go to additional information, the last point, we are told that 15,000 units were produced and sold at a selling price of 53 rands. So obviously, to get the total sales, we are going to say 15,000. We multiply by 53 rands per unit. Then we get the total sales. So we come here in brackets, we show that working, whereby we are saying 15,000. Then we multiply by 53 rands. So when you multiply there, you're going to get your answer is 795,000. Then after the sales, we are going to less our total variable cost. So here, so I believe this we are going to add list all the variable costs that we have requested, and then the total should come here. So going back to our question, we can see that we are given manufacturing overhead control, and also we have what the labor control, material control. So basically, on our variable costs, we are going to consider our direct, we've got material control, whereby we have the material that is being transferred to the production control. It represents direct material. We've got 105,000 being a variable cost in terms of direct material, 105,000. So we come to other section, we say direct material, and we've got 105,000. So we list it here. Moving forward, you see that the next that we've got the one that we have for labor, which is product and labor of 150,000. So It's also a variable cost. So I'm moving on to that. Now we have a continuation of the information that we are given from labor control. We have a manufacturing overhead. So out of manufacturing overheads, obviously the total figure that you have for 170,000 that is being transferred to production control represents the total, which is we have got a proportion of fixed and also variable. Fixed manufacturing overheads and variable manufacturing overheads. So we need to see the proportion for variable as we are looking for variable cost. If you come here, you see that we are told that 45% of the manufacturing overheads are fixed in nature. So basically, if 45% is fixed, so it means the variable one is 100 minus 45. And then we are going to get 55% being variable. So to calculate the variable components, we are now saying 55% of 55% of the total for manufacturing overheads is 170,000. So we calculate it like that. You are going to see that you're going to get 93,500. So we have the variable manufacturing overhead. Variable manufacturing overhead. So we can write to space, we are just abbreviating variable manufacturing overheads, and the figure that we got is 93,500. So basically that's what we have. And then we go to the next part whereby we now have the selling and administration. Also inside our selling and administration of 110,000, we also have a proportion of fixed and also we have got variable. So we need to see what we have in terms of the proportion. If you look at the second point, saying 60% of the selling and administration costs are variable. So basically this one is straightforward. We take 65% as variable of selling and administration. So we are going to say 65% we multiply by the total for selling and distribution, which is 110. We multiply by 110,000. And we see what we get there. So if you multiply, you are going to get it is 71,500. So here we say variable selling and distribution. Variable selling. Variable selling and distribution. And you got the answer is 71,500. Then we have exhausted all the variable. So you can now add 105,000 plus 150,000 plus 93,500 plus 71,500. Then we get our total variable cost, which is supposed to be 120,000. So we are saying less here, which means we are subtracting. So we can show in brackets that we are subtracting. Then we now say 795,000 minus 420,000. Then we get our figure for marginal income, which is 375,000. So this is what we have. And the figure that we have there is marginal income. So here we are saying marginal income. So having that now, we can now be able to go forward as we subtract the total fixed cost. So basically, I believe that we are going to say less total fixed cost. So we list the fixed cost that we have, but obviously we are going to first go use the first point by saying 45% of manufacturing overheads are fixed. So basically, it's now clear. 45% of manufacturing overheads are fixed. So what does it mean? We say 45% times manufacturing overheads, which is 170,000. And then we get the fixed component inside our manufacturing overheads. So we get 76,500. 76,500. So we come here, we say fixed manufacturing overheads, and then we got it as 76,500. Then moving on, second point, we are told that 65% of the selling and administrative costs are variable. So it means the fixed component is 100 minus 65, and we are going to get it as 35%. So basically, we are saying since we are being told that 65% of the selling and administrative costs are variable, so the fixed component inside is going to be 100 minus 65, and then we get to 35%. So here we are going to say 35%, and then we multiply by 110,000 for selling and administration. And then you get your answer 38,500. So this is what we have there, and then we can be able to say selling and administration. Selling and administrative, we have 30,500. So that's what we have. Then to get the total fixed cost now, we are saying 38,500 plus 76,500. And we get 115,000. So let's take note, we are saying less here. So it means also we are subtracting. So we are now going to say marginal income minus total fixed cost. And then we are going to get our final figure as our net profit. Net profit or net loss, depending on which one is greater. In this case, we've got marginal income being greater than total fixed cost, so it becomes a net profit. But if we had marginal income less than total fixed cost, it was going to result to a net loss. So in this case, we are going to say net profit, and then the answer that we are going to get now, is the difference is going to be 260,000. So this becomes our final answer. So basically, that's what we have on that part, preparation of the income statement using the direct cost method. Then we move on to the next part, which is now going to be 5.2. So 5.2 is saying calculate the break-even quantity. Calculate the break-even quantity. So break-even quantity, we need to put down the formula first. We have our 5.2. What does the formula say? It says total fixed cost. So this is break-even quantity, which is total fixed cost over marginal income per unit. Over marginal income per unit. So what do we have in terms of those figures? Total fixed costs we have already calculated here, and we got 115,000. So this is going to be our numerator, which is going to be 115,000. And then we divide by marginal income per unit, of which marginal income per unit is marginal income, we've got 375,000. 375,000 is marginal income, which we are using here, and divided by the number of units so that we get the per unit. If you come here, you'd see that we are told that we have got 15,000 units produced, so we divide by 15,000. So basically, we are saying it's 115,000 are divided by, sorry, 375,000 for marginal income are divided by 15,000 number of units. So we are saying brackets 375,000 divided by 15,000 in brackets. So with that now, we can see that if you try to simplify it further, it becomes equal to 115,000 divided by 375,000 divided by 15,000. You are going to get your answer as 20. Let's try to see as 25. And now we say 115,000 divided by 25, and you get your answer as 4,600 units. So this is the break-even quantity. Then we move on to the next part of our question, which needs us to calculate the break-even value. So what is important is to bring down the formula first. So break-even value So this is the break-even value. So break-even value, we are going to say break-even quantity times selling price per unit. It's equal to break-even quantity times selling price per unit. So basically, we simplified further break-even quantity. We have already calculated it to be 4,600. So we say 4,600, and then we multiply by selling price per unit. You are given it here, which is 53 rand. Calculate it, the answer that you are going to get becomes 243,800. So basically, that's what we have in terms of our break-even value. So moving on to the next part, we now have calculate the safety margin as a percentage. Safety margin on its own is the sales value minus the break-even value. Sales minus the break-even value. Then as a percentage is now over the sales figure. So basically, we are now saying the formula that we have says it is equal to sales minus break-even value over our sales. Then we multiply by 100 over 1. So basically, that's how we're going to calculate it. So for our sales, we can get it in our income statement, whereby we got it as 795,000. So here we are saying it is equal to 795,000 minus break-even value, which is 243,800. Then all over our sales. Our sales is 795,000. And of course, we are going to multiply by 100 over 1. So we calculate it in such a way. We see that you are going to get your answer is 69 69.333%. So rounding it off to our nearest whole number, it becomes 69%. So basically, this becomes your final answer. So that's what we have on 5.4. So moving on to 5.5. 5.5 is draw the break-even graph using the information above. So in terms of coming up with the graph of the break-even, we are break-even quantity, break-even value, we are going to be making some references in terms of certain figures that we have that we have already calculated. So what is important for you is to identify where you have your break-even value, where you have your break-even quantity, and also the sales value figure and the quantity that has been produced. Those are some of the variables we are going to see being indicated on our graph. So also, let's start by showing our axis, whereby we put our vertical axis and our horizontal axis. So we are saying this is going to be the vertical axis. This is going to be your vertical axis, and this is going to be your horizontal axis. So basically, that's what we have. And let's take note, this is the point of origin. We indicate it as 0, indicating a point of origin. So our vertical axis represents our y-axis. So we have y-axis, and the horizontal axis represents our x-axis. So having done that now, we can start by coming up with the total sales curve. Remember, the total sales curve is the 45-degree line. Remember, our angle here is 90 degrees. So we draw a curve from the point of origin being a 45-degree line, whereby it's going to cut the 90-degree line at the middle into two halves, two equal halves. So that becomes our total sales curve. So we can come up with that one. Whereby we have typically curve like this being the 45-degree line, and we are going to label it as our total sales. Then from there, you can also be able to draw your fixed cost curve. But what's important is to refer back to see what is the total fixed cost that we have. Total fixed cost, we see that we have total fixed cost is 115,000. So it means if you come here, it means we can put our fixed cost here as 115,000. And our fixed cost curve is an horizontal line, or we can call it a perfectly elastic curve. It is an horizontal curve like this. This represents our fixed cost. Why is it horizontal? It's because the fixed cost do not change with the level of output. We've got at the same fixed cost, which is going to be 115,000 in particular in this question. So our label here is fixed cost. And then our total cost will start from where we have our fixed cost, because when we have got 0 output, remember also on the horizontal axis, we are going to have our quantity. You can just add on another label on the horizontal axis, whereby we have got the quantity. We can have our label here, whereby we are saying quantity is in particular, it's in units on the horizontal axis, and here we are going to have our value. we are going to have our value, which is obviously in rands, or you can say cost or revenue, cost or revenue being our vertical axis. So what we are saying is our fixed costs are not changing with level of output, whether we produce 0 units, or you incur the same fixed cost, which is 115,000. Whether you produce 1,000 units, you're going to have the same amount of our fixed cost, which is 150,000. So that's where we're going to have our total cost starting from. Remember, total cost is equal to fixed cost plus variable cost. So even at 0 units, you have some costs. So we're saying we start from here to get our total cost curve. So basically, we can just have our curve starting from here. This becomes our total cost curve. So we can just give a label. Total cost curve. So basically, we have all the three curves that are necessary for the break-even analysis. So let's now identify our break-even point. Remember, our break-even point is the point where our total sales are equal to our total cost. So this is the point that we are having total sales equal to total cost and the intersection of the total sales curve and the total cost curve. So this is the break-even point. We can label it the break-even point, whereby we now have the break-even value being on the vertical axis. So if you come here, you come to the vertical axis. And that's where we are going to have your break-even value. And remember, we calculated this break-even value, and the figure that we got as break-even value is 243,800. So it means that's the description that we are going to have there, which is 243,500. 243,000. We can have what 243,800. And then we also have our break-even quantity now on the horizontal axis, whereby we are showing it by going down. So there we have our break-even quantity. We calculated it and we got 4,600. So it means here we've got 4,600. Right, so that's what we have. Then we have our sales. Our sales, remember, we did refer to our sales in 795,000. So our sales will be represented as the total revenue that we have. So we can indicate our sales at this point, whereby we have put our sales and we indicated that it's 795,000. So we can as well try to remove this so that we have the 795,000. And we can only achieve these sales when we have sold all the quantity that we have produced, which is 15,000. So it means on the horizontal axis again, we are going to have our 15,000. So it means here the quantity that we have is 15,000. 15,000. So basically, that's what we have in that sense. And then we can as well try to include our description of vertical axis, whereby we are saying it's cost or revenue. Then in brackets, we are saying in rands. So you have given the description of our vertical axis. So basically, this is our break-even analysis the graphical representation of the break-even analysis. So all the major points we have indicated. The break-even point, we are having it where we have got the intersection of the total sales gap and the total cost gap. And then we also have the maximum production of 15,000, giving us revenue of 795,000, which is sales. And then we also have our fixed costs are being indicated by 115,000, producing a fixed cost curve, which is an horizontal curve. Or we rather call it a perfectly elastic curve, which is horizontal. So basically, that's what we have. We've got a point of origin being indicated. So basically, that's what we have. With that, you can be able to attain your 8 marks that are required on 5.5. So thank you for listening, and hopefully the video was helpful. And please listen and let's stay tuned for more videos to come. More typical examination questions will be uploaded on this channel. So let's stay tuned. Let's meet again in the next video.